Good morning, everyone. My name is Matt. I cover the IT stocks for PSG Wealth, and today we'll discuss the fourth quarter results for Microsoft, and we recently released a company update report on that in the last couple of days. Just very briefly, the event was the fourth quarter results. The results missed expectations. Sales were up 12%, operating profit up 7.5%, net income and earnings per share up 2% and 3% respectively. Despite missing the expectations, the shares held up quite well, and they were actually up 4% in after-hours trading, and that brings the performance for Microsoft 9% higher for July. And then our assessment, it's largely unchanged. Our valuation has changed slightly, but not by much, and we've kept our recommendation on hold. So just going quickly across the results. So the sales increased by 12% to 51.9 billion. Sales were driven by the intelligent cloud segment, which grew 20% to 21 billion. And that now makes up 40% of the group's total revenue. The productivity and business processes were up 13%, and the more personal computing segment was up 1.9%. So the results were negatively impacted by a couple of factors. So this is the stronger US dollar, production shutdowns in China, a weakening PC market, which impacted the OEM business, advertising and spend reduction, and that impacted LinkedIn and the search business, and then the ongoing war in Ukraine, and that resulted in a bad debt expense from scaling down the operations in the region. If you look at growth across Microsoft's products and services, most of their businesses are still growing at double digits. So Azure was up 40%, LinkedIn was up 26%, search advertising up 18%, Surface was up 10%, and that's faster than what we've seen with Apple in their Macs and iPad division. So Macs were down 10%, iPad was down 2%, and then in Office Commercial, that grew 15%. So very strong results across a strong portfolio, although those growth rates are slowing down. The cloud business is growing faster than AWS. So AWS is Amazon's cloud business. And then overall net income and earnings per share were up 2% and 3%. So the outlook that management gave, and Microsoft normally gives quite comprehensive guidance, and they're still expecting double-digit revenue growth for FY23. And that was more or less in line with what the market was expecting. Then on the impact, we've got a very tough start to the year for Microsoft, but the whole sector and most of the market is very similar. The results were robust, and the momentum is helping Microsoft regain some of the year-to-date performance that it's lost against the benchmark, but it's still down 16 to 17%. And then just finally, getting to our assessment, we value Microsoft by applying a 5-year average peer EV/EBIT and EV sales to Microsoft's 3 core businesses, and there have been no real changes there. And then we do think Microsoft has got much higher qualitative factors than its peers, but our valuation suggests that it's quite full at the moment. What we like about Microsoft is that it's got massive network effects in its productivity business, beneficiaries from work from home and the post-COVID hybrid working model. They're huge beneficiaries of the secular growth in cloud. Their business is massively scalable. They've got pricing power and annuity type revenue, and obviously their revenue is quite diverse across quite a diverse product portfolio. But what we don't like is that the valuation is quite full. So any negative surprises could provide some further downside to what we've seen this year.